Welcome back, everyone, to this week's Kingscrowd Investment Roundtable. As always, we are the Kingscrowd team that you are joined here by today. Myself, my name is Brian. We also have Leia and Teddy. Today is going to be a special episode of the Kingscrowd Investment Roundtable, as we are going to talk about not necessarily companies or pitches that are pitching today, but we're going to do a review and a recap of 2024. We looked at thousands of deals across dozens of platforms, and we've pulled together all of that data in one place to be able to extract different key investing insights and takeaways for all of you, our audience. What we're going to do is walk through a couple different charts that summarize last year, and then we can also each present some of our own takeaways from each of these different charts. So I will pull up my screen, and the first chart we're going to take a look at is going to be the total annual regulation crowdfunding, online investment crowdfunding investments by year. Now, this chart shows all of the years, basically from 2018 to 2024. So it's kind of a snapshot of the last 7 years. And what we saw leading up to, COVID in 2021, obviously, was very high annual growth. We went from nearly 74 million, 75 million total to nearly 500 million at the peak in 2021. Now, since 2021, we've been seeing a bit of a pullback each year. It pulled back a little bit in 2022 and 2023, and then we did see about another 18% decrease to 343 million total raised in 2024. Now, the breakdown in the colors that we're looking at here is in purple is basically the equity safes, convertible notes, basically equity-based deals. Teal is more of the debt and revenue share based deals. So you can actually see, compared to 2023, debt and revenue share offerings held pretty steady year over year, whereas we did see more of a pullback in terms of the equity crowdfunding markets. Now, Leia, Teddy, what do you take away from this, taking a look at this chart, and where do you think we're going to be going looking forward into 2025?
Yeah, I think as one of the later charts shows, like private market activity, and including venture capital, obviously, has also been decreasing since the 2021 peak. A big part of that is, in my opinion, it's venture capital markets generally move in tandem with the IPO markets. Like when the IPO markets are really hot, a lot more money gets into venture capital as well, and quite a few studies showing that. And I think generally private market investors are hopeful of the IPO market as a whole just really growing next year as a result of many things. But I think, we're going to see a bump there in VC. And we also see that equity crowdfunding also moves in tandem with VC. So I think it's all kind of intertwined. So I think next year is going to be a big year, and I'm hoping for an increase in the equity crowdfunding markets.
Yeah, real quick, and then I want to get Leia's take on it as well. So just on your note, Teddy, of looking at venture capital versus, online investment regulated crowdfunding, this chart basically normalizes both venture capital in teal and regulation crowdfunding in purple here to $2018. And you can see that Reg CF actually saw much more of an increase going into 2021, and it's seen a relatively lower pullback. So the roughly still at 450% of 2018 dollars versus venture capital, which is, just a little bit over, say, 130% when you're looking at kind of the estimate for the year end of 2024. So that being said, I think this chart kind of tells the story that Reg CF has been experiencing more growth. There's been more investment volumes coming into it, and it's pulled back a little bit less. But to your point, I think we're going to have to wait and see in terms of just changing administrations and the regulations and all the other different things, interest rates that go into driving private market investor behavior. Leia, what are some of your takeaways from looking at this data?
Well, you see, in 2021, there's a lot of reasons that explain why investors suddenly just overflowed the ECF market. We know that people had a lot of money sitting on their bank accounts. We know that they were also staying at home quite bored, trying to do new things. We also know that the stock market was doing extremely well. And I do think that all of these factors kind of made people look at crowdfunding like something exciting. But to me, another reason is that in 2021, we had so many exciting IPOs that really made a lot of VC rich. And when I see that the stock market is kind of steadily going up again, it's looking way better than it was looking in 2021. I would assume that we're going to see a lot of beautiful IPOs in 2025 that hopefully can give a little bit of FOMO to retail investors who will be like, well, I wish I would have invested early in these companies, and hopefully they can get interested in early stage investing again. Not that they're not interested anymore. I mean, if we look at 2024 compared to 2020, we're still as close to 2x the amount invested in 2024 compared to 2020. But for me, in order to see this number going up again, we need to acquire new retail investors. And for that, we need to show them that there can be amazing returns to be made through private investments.
That's an excellent point. Just going back to this venture capital deal activity chart. So this is from PitchBook showing all the venture capital deal activity where deal value is the size of the bar and the deal count is this line here. Now this was prepared in Q3, so they had year-end estimates, but one of the important things to understand in terms of fund dynamics, right? These venture capitalists raise their funds. That's when they go out to their LPs, their limited partners, and they say, hey, this is the fund thesis. This is what we're going to be investing in. Will you commit capital? Then they have to deploy those funds, which is a several year process. Then they have to wait for those funds to actually return. So I think we saw tons of VC fundraising and new people opening up new VC funds in 2020, 2021. They've been deploying over the past few years. But now, to your point, we're kind of in that phase where we need to wait and see what are the actual returns going to be of some of these different fund vintages, because those LPs don't get their money back. They're not able to redeploy into the market until they start seeing some of those returns. I think even in terms of just crowdfunding, regulated crowdfunding, and this chart here also shows it alongside Regulation A. So one of the differentiations here, right, is that companies can raise up to 5 million under Reg CF versus up to 75 million under Reg A. So usually Reg A tends to be more mature issuers, but you can actually see Reg A even has been a little bit more of a steep pullback compared to 2021, shown in red here, compared to the purple again, which is Reg CF. So it's kind of telling us, I think, that on the investor side, people are a little bit more experiencing and perhaps showing a little bit more patience, where they want to see, are these bets actually going to pay off? We've been investing for 4 or 5 years, many people now, but waiting to see, are they going to IPO? Are they going to get acquired? So it'll be definitely interesting as we go into 2025 to take a look at that. Let's move on to another chart. So this one just real quick to touch on, and then I want to get into some of the top platforms for the year. But we actually had record high equity crowdfunding deals. The number of active deals as of the end of December 2024 was roughly 570. That actually broke the prior all-time high for number of active equity crowdfunding deals back in early March of 2022. So again, what this is kind of saying is you have the dynamics of this two-sided marketplace. You have the companies, the issuers, who are actually looking to raise capital, and you have the investors. And we're actually seeing that the number of companies that are raising capital is more than it has been at any time in the past, even during the peak of the 21 era. So I think we're waiting just to see more of that investor side of the marketplace to come back and start investing their dollars. And again, we'll have to see if it's a big exit or two that kind of make a name for the industry, get investors a bit more excited again to be able to do that. Let's take a look at the top platforms of 2024. So as a reminder, any offering that's being done online can be done on a broker-dealer platform or a funding portal, but all of those offerings basically run through those entities for Reg CF. And so we at Kingscrowd track all of the investment dollars that are being done on each of these different platforms. What we saw in the results for 2024 in terms of total capital raised, total capital invested on these platforms is a somewhat similar story to what we've seen in 2023. So WeFunder, Start Engine, and Dealmaker were the top 3. Those were the same last year for Reg CF. Now, surprisingly, Dealmaker's actually been doing a very big job in terms of raising capital. They surpassed Republic and took over that 3rd spot for the first time last year. Republic is still in the 4th spot there. And then we see some other familiar names, as you kind of round out the top 15 or so, where all other platforms, and this is probably a couple dozen here, right, that maybe have 1 or 2 smaller offerings, amounted to roughly 29 million. So, Leia, I'll toss it back over to you, but what do you kind of see when you look at this chart, and given how many deals you look at each week and as you assess them for the Kingscrowd Capital Fund, what does this speak to you?
Well, when we look kind of what is behind the data, we know that WeFounder has way more deals than any other issuer out there. So even if in total they've allowed the companies rating on their platform to raise more money than other platforms, in actuality, when you take a deal per deal basis, I think the median amount raised on WeFounder is somewhere around $100,000. Start Engine is somewhere around $200,000, and Dealmaker is somewhere around $400,000. So what this chart is not telling us is that bigger issuers are raising on Dealmaker than on Start Engine and then on WeFounder. And I think it's just very interesting for investors to know that, because I mean, when you go on Dealmaker, you're going to see deals that are raising way more money, but also companies that can be more advanced. Start Engine, you're going to have a little bit less money raised than a Dealmaker, but still a mix between early stage and more growth companies. And on WeFounder, not all companies, but most companies are going to be early stage. And that's why you have also a lot of companies that will not perform. Looks like WeFounder has doors maybe that are a little bit more open. I'm not sure what their policy there, but it's important as an investor to know that so you can really understand what these numbers mean.
Really good point. Teddy, how about you?
Yeah, I think it's something we've touched on in prior episodes, but kind of as equity crowdfunding continues to mature, like kind of makes sense that there are a few big players really starting to dominate the dollars raised. And I think especially in this time of investor pullback across the private markets, you are going to have less. These smaller portals and really specialized portals may not have as much of a chance to get investor interest, because investors are investing less. So they're looking for the highest quality, and they're going to use most likely the most trusted platforms, as opposed to giving a chance to some of these more obscure platforms that don't necessarily have any type of track record yet, or things like that. So I think this kind of makes sense as the space matures, and probably as these, if any of these smaller portals do start gaining a lot of traction, we'll probably see more consolidation, like we already saw this year with Honeycomb Credit. It's not too surprising that there's kind of three dominating, and then I think the fourth spot was like 15 million.
Yeah, Republic was 15.
Yeah, so like there's that huge drop off the top three. So
right.
We'll probably see this even become more prevalent next year. I wouldn't be surprised.
Yeah. I think, just to add to both of those observations, a lot of places in life, this 80-20 principle, the Pareto principle, kind of applies. And we definitely see it playing out in terms of, total number of offerings as well as total capital raised with the platforms. Now, I will mention, some of these funding platforms here aren't necessarily trying to be, obviously they would all love to be, just in terms of revenues and having lots of issuers, but, some of these cater to very niche audiences. I'm thinking of like angel funding, for example, right? Where they're not trying to be a one size fits all, any issuer can come and raise on them. They focus on very specific types of offerings into the films that are backed by their community. So some of these are going to probably stay niche, whereas other ones, some of the broker dealers that we've seen in the past, like Dalmore, Net Capital, they definitely would want to go more broad, I think. So it will be interesting to see those dynamics kind of play out. The other thing I'll just add too, so we threw, when you look at Regulation A, Reg A Plus, there's many fewer platforms that do that. So this is most of them here. And you can see Dealmaker took up 50% of all offerings done through Reg A for last year. So when we look at Reg A Plus, what we're tracking are, we're not looking at real estate deals. We're looking at operating companies and being done on these online platforms. Dalmore Group is another huge name in the Reg A space. They also do a ton of the fractional space, the offerings on platforms like Rally Road and Masterworks, that type of thing. Dalmore actually runs all of those through their broker dealer, but this is just tracking operating companies here. Start Engine also, and something that we don't have in the data this year, but that's been an interesting trend to watch, is that some of these top platforms like Start Engine, Republic, I'm trying to think, there's probably a few others, but they do more private offerings. So they have offerings that are accredited investors only, and they've been giving allocations to, some big name companies. I'm not saying these are necessarily the ones, but it's, the SpaceX's, the Perplexities, some of the big AI names in the space today. They are giving more, let's say, Reg D allocations to some accredited investors. But in terms of Reg A, right, again, we're kind of seeing just a few of these platforms, dominating a lot. And then there's a few of the smaller ones as well.
So on Reg A, is the reason for this, I don't know, like super detailed of like what it takes to become a Reg CF platform versus a Reg A, because running a Reg A is significantly more expensive and requires way more disclosure. So I'm assuming starting a Reg A platform is like also way more expensive. Is that why we probably see way less of them?
Yeah, so it's definitely more expensive for the issuer. Also, it depends probably on the type of entity. So I could be getting this wrong. So do your own research, obviously, not legal advice, but I believe funding portals with Reg CF, you're doing Reg CF offerings. To do Reg A offerings, it's usually a different type of legal entity or a different structure that you will set up. So that's why you will sometimes see some of these companies have a funding portal arm as well as a broker dealer arm. And you'll see that actually a lot of these names, so Dealmaker, Dalmore, Start Engine, Rialto, they actually have broker dealers. And I think usually it's the broker dealers that are doing the Reg A placements and the Reg A offerings here.
That's very interesting because from an investor's perspective, there's not that much difference when you invest $200, $300 in a company, whether you invest with Reg CF or Reg A plus. Yes, the reports that you're going to get are going to be different. There's more fees for the company on Reg A. But what this tells me is if I add the amount of money that Dealmaker raised through Reg A with Reg CF, they're the leader, right? We have close to 50 million with 120 million. That's about 170 million out there, which is way more than WeFunder's 99 million. Same for Start Engine, 32 plus 85, we're somewhere around close to 120 million, I think. So they are actually number 2. And I think that if you're an investor, retail investor, you invest small checks, Reg CF or Reg A doesn't really make that much difference for you. And so it's very important to do the math and understand that WeFunder is number 3 if you add both numbers.
Yeah. So Dealmaker is really dominating this now.
Yeah. And another reason that's super interesting is that Dealmaker is not necessarily the type of marketplace where you can go to Dealmaker, securities.com and look at all the offerings side by side. They are usually working with specific issuers and then going out and marketing directly to their audiences. So a lot of the times you have to be on that mailing list or find the opportunity through Kingscrowd to even know that company's raising capital. Whereas a WeFunder or a Start Engine, you can go to WeFunder.com or Republic.com and you see all of the offerings that they're doing. So to be able to raise that much capital and without having it on a marketplace like that, it's pretty interesting for sure. Now, in terms of just platforms by number of offerings, because we thought this was also interesting to take a look at, WeFunder again is usually up there. They had nearly 340 new offerings that launched in 2024. Honeycomb Credit. So this is, again, that platform that's allowing, kind of these more debt-based offerings, also taking the second spot in terms of number of new offerings that launched in 2024. Then we get down to Start Engine, and you can see those 3, again, very far ahead of the rest of the pack, whereas everyone else had fewer than 100 new offerings launch in 2024. So that's the Dealmakers, Republics, and the others, which was kind of running out the top 15 here. All right, let's get towards the end and wrap things up. So another thing we did take a look at is valuations. This is, another reference from PitchBook, just showing, again, this huge spike in valuations that we saw in 2021. Pulled back a little bit. You can see seed through Series D here. So especially later stage deals is accentuated through what you can see on this chart. But for early stage, if we're talking that seed, which tends to be a lot of Reg CF companies, venture capital saw median deal valuations around that 11.5 to 13 million. When we take a look at the average equity crowdfunding valuations since 2018, we've actually seen a pretty steady increase. If you go all the way back to January 2018, a few little blips here, and you can tell that it's sometimes driven by the huge outliers. For example, when a Boxable comes and they have a $3 billion valuation, that's going to be throwing the average off a little bit. But, we're seeing a steady uptrend, which might be a little bit counterintuitive because I think something Teddy said earlier, right? When you see the public markets kind of correcting and you see multiples coming down, revenue multiples, you tend to expect to kind of see that through a little bit of a lag into the private markets. But I think one of the things that I'll just mention that we've seen is since the regulation changes in 2021, when you can now raise up to $5 million under Reg CF, we're actually seeing more mature issuers coming in. So whereas before certain companies might have said $1 million, not really worth the cost of capital, maybe not worth the time, they look at $5 million and they're like, hey, actually, we can do a lot with 5 million. So I think we're seeing companies come in with more traction and more revenue. So it's somewhat of that effect, not just an overall valuations trend. But, I'm curious, Leah, Teddy, with all the companies that you're looking at and valuations in general, what are some of the trends that you saw in 2024?
On my side, I think I was hoping to see valuations lowering, and it's not the case. One of the realities of the equity crowdfunding market, and that's why a lot of founders like it, is that they can set their own valuations on their own. They choose it. And so in a lot of cases, clearly they are the one benefiting from the higher valuation because they're going to sell less equities, they're going to be less diluted. And so a lot of founders are putting valuations that are way too high. And that's okay. That's how the market is. Now, that's why Kingscrowd is here to tell you, do the in-depth research and tell you whether investing in X deal at Y valuation actually is worth it or not. We can find amazing deals that are just completely overvalued and that completely diminishes the impact that that's going to have on your portfolio. So it's one of the realities of the market. It's called democratization of investing, right? Everybody can invest, but also every founder can raise money. And so sometimes lack of regulation or different power play in the market is bringing, in that case, valuations higher up. So you just have to be careful. But sometimes even an overvalued company could potentially be a good deal for you. So you really just have to do due diligence.
Yeah, I think overall valuation inflation will always be a thing in equity crowdfunding. There are always going to be tons of companies that are valued way too high based on their traction. If it's a follow-on round, then they jack up the valuation, but don't really have the traction to back that up. So that's something me and Leah and Brian, we all look at all the time to justifying valuations. And I'm hoping that we see more of the Elemental Healths of the world who had a massive down round that was very much justified, and they had a great explanations for it, and a real stabilization of the business and raising at that lower valuation made a lot of sense, and they were able to tell that story to investors, where I feel a lot of startups would have just kept the same valuation or really raised it despite negative things that have happened and without really explaining it. And I think the more we see founders kind of following the logic of their valuation trends and being able to back it up, the better the industry will be. So I'm hoping to see more of that next year.
Observations. And I'll just point out for anyone watching this video, make sure you head over to Kingscrowd. Definitely check out. We're going to have a lot more charts and explanations about all of this data as well. There's a lot more nuances that go into this chart, and we'll be explaining more of that with some of the additional charts of the week also that we share throughout the year. The very last chart, and then we'll wrap things up. One of the big promises all along of investment crowdfunding and regulation crowdfunding is this concept of democratization, both in terms of giving access to new investment opportunities that were traditionally off limits to investors, as well as traditional access to more diverse sources of capital for the entrepreneurs. So one of the things that we track looking at Kingscrowd are things like minority founders, women founders, and how they are performing in terms of, both compared to VC as well as just raw in terms of looking at the markets. So when we look at the number of companies that have launched with women founders, so this could be solo women founded teams or mixed gender teams, we saw a bit of a dip in 2021, but as a percentage, so the red line here is a percentage, we actually saw the highest percentage of deals that launched in 2024 had at least one woman founder on their team. Now, when we look at the capital raised, the situation isn't as bright, but when you compare this to VC, a lot of the numbers for VC does tend to be worse than this. So, it does tell the story that regulated crowdfunding does seem to be a little bit better in terms of being able to allow access to more capital for women. So here we're looking at total capital raised. Again, we see a trend where there was a dip for women where they raised less percentage of total capital in 2021, but we've seen that hover around between 24 to 26%, where women raised, teams with at least one woman founder raised 27% roughly capital of overall capital raised in the markets. Any last minute takeaways from, Leah, Teddy? I'll toss it over to you guys from either of these charts.
Well, that's very good to see that democratization of investing is working compared to VC. Women are getting way more money that they could get from institutional investors. However, I agree with you. When I look at it at first, I'm like, well, they're raising more money than the number of dealers which they are represented, so that's not good. But then I'm trying to think about which of the companies are actually the outliers in the equity crowdfunding, meaning which companies are the ones that are raising, 70 million, because they're going to skew the numbers. And usually we have these companies like Energy X, Aptera Motors, where these are sectors that are just underrepresented by women. You have not a lot of women that are founding car companies or deep tech companies, which there probably should be more, but they're not that much. And so to me, it's not that investors are not investing in women as much as they're offered, just as women have different type of deals than men, and they may not have these deals that will raise millions and millions of dollars, but just because they're in different industries. And that could be actually a good data point to look at for us for the future.
That's a great point. All right. Well, we have just kind of touched upon some of the different data and analysis for the 2024 report here. If you want to check out the full report, head over to kingscrowd.com. Also, we share a lot of these insights on our weekly newsletter that's available at pitchreviews.com. It's completely free to sign up for. We share a lot of this data-driven insights and analysis. So whether you're a founder looking to raise capital from your audience or raise capital online, or an investor look to get more educated and more knowledgeable information and advice on companies, be sure to check us out. We will sign off here. Until next week, thank you all for joining us.